Something strange is happening again, and almost nobody on the surface wants to say it out loud. The signal that flashed before the last global financial collapse is blinking again, quietly, steadily, and with far more intensity than before. Back then, most people missed it. This time, it is louder, sharper, and embedded deep inside the machinery of the global system itself. The year is 2026, and the warning signs look uncomfortably familiar. 4 days ago, on December 23, 2025, silver crossed a threshold it was never supposed to reach. Not slowly, not cautiously. It surged, it broke $70 per ounce, then $72. Then it kept climbing. By December 27th, silver was trading near 76, and behind the scenes, 5 major American banks were already bleeding more than $30 billion in losses. This was not volatility. This was not speculation. This was not a temporary spike. This was structural failure beginning to surface in real time. Financial media called it a metals rally. Analysts said it was inflation hedging. Commentators said it was just another commodity cycle. But that framing hides what is actually happening. What is happening is that a system built on promises is colliding with physical reality, and physical reality is winning. For decades, silver has existed in 2 separate worlds that almost never touched. One world is physical, real metal. Bars, coins, industrial stockpiles, vaults, warehouses. The other world is paper. Futures contracts, derivatives, exchange-traded products, synthetic exposure. In the paper world, silver can be created endlessly with a keyboard. In the physical world, it must be dug out of the ground, refined, transported, and stored. The paper world grew so large, so dominant, that it began setting the price for the physical world. And that imbalance is now breaking. For more than 15 years, a small group of major banks held massive short positions in silver. According to data from the Commodity Futures Trading Commission, these institutions collectively sold hundreds of millions of ounces they did not own, promising delivery later at lower prices. At one point, their combined short exposure exceeded 700 million ounces. That is nearly an entire year of global silver production. When silver traded in the low 30s in late 2024, these banks were already under pressure. At $33 per ounce, their losses were estimated around $1.3 billion. Painful but manageable. But silver did not stop at 33. Every single dollar silver rises cost these banks roughly $78 million in additional losses. From 33 to 76, that is a move of $43. Multiply that out and you get more than $30 billion erased. Not theoretical, not paper, real balance sheet damage, and the price is still moving. The problem is not just the losses. The problem is that these banks cannot simply close their positions. They sold silver they do not have. They promised delivery. And now the buyers are asking for exactly that. Delivery, this is where the system begins to crack. When a trader sells a futures contract, they are obligated to deliver physical metal if the buyer stands for delivery. Most of the time, that never happens. Contracts are rolled, closed, or settled in cash. For decades, that assumption held. The paper market could grow endlessly because almost nobody asked for metal. But something changed in late 2025. Industrial buyers, funds, and sovereign entities began demanding real silver. Not cash, not exposure, metal. And when that happens, the math stops working. In the first 4 trading days of December, more than 47 million ounces of silver were claimed for physical delivery on the COMEX exchange. That is over 60% of the exchange's registered inventory gone in less than a week. Registered inventory is the portion of silver that is actually available to be delivered against contracts. Not eligible, not theoretical, deliverable, and it collapsed. To understand how extreme this is, consider that in 2020, COMEX held roughly 346 million ounces of registered silver. Today, that number has fallen to around 150 million. More than half has vanished. And the withdrawals are accelerating, not slowing. This is not isolated to one exchange. Shanghai's futures exchange has seen its silver inventories fall to the lowest levels since 2016, below 446 metric tons. London vaults are reporting similar strain. Across the world, physical silver is being pulled out of storage faster than it can be replaced. And here is the part that almost no one wants to confront. The global silver market has been running a structural deficit for years. according to the Silver Institute. 2024 marked the fourth consecutive year in which global demand exceeded total supply. That year alone, the world consumed approximately 282 million ounces more silver than was mined and recycled. 4 straight years of deficits have drained above-ground stockpiles to critically low levels. This is not a trading anomaly. It is a physical shortage. Silver is no longer just a precious metal or a monetary relic. It is an industrial necessity. Solar panels require silver paste for conductivity. Electric vehicles rely on silver in motors, contacts, and charging systems. Data centers, artificial intelligence hardware, 5G networks, medical devices, defense electronics all depend on silver's unmatched electrical and thermal properties. There is no substitute that performs the same role at scale. The solar industry alone consumed roughly 200 million ounces of silver in 2024. Electric vehicles added around 90 million more. Together, that is nearly the entire annual output of the global mining industry, and demand is still rising. Unlike oil or gas, silver supply cannot respond quickly to price increases. Around 75 to 80% of silver production comes as a byproduct of mining other metals like copper, zinc, and lead. That means even if silver prices double, miners cannot simply decide to produce more silver unless the economics of those base metals also justify expansion. Supply is rigid, inelastic, slow, and while supply is constrained, demand is accelerating. This is why the current situation looks eerily like the early stages of 2008, except more dangerous. Back then, the stress was hidden inside mortgage-backed securities and credit default swaps. Today, the stress is buried inside commodity derivatives and physical supply chains. On December 2nd, 2025, the Commodity Futures Trading Commission released its monthly bank participation report. Buried in that data was something that stunned longtime analysts. For the first time in recorded history, United States banks flipped from net short to net long in silver. For decades, U.S. banks were always net short. Every single month, it was as reliable as gravity. Analysts like Craig Henk, who has tracked these reports since 2014, had never seen a reversal. Until now. The combined group of 22 banks still showed a small net short position overall, but U.S. banks specifically had moved long. That means they stopped betting on lower prices and started positioning for higher ones. That shift alone tells you everything. These institutions see what is coming. They have access to vault data. They see delivery requests in real time. They know how thin the inventory truly is. And when the largest players in a manipulated market suddenly switch sides, it is not because they had a change of heart. It is because the risk equation has flipped. No institution illustrates this better than J.P. Morgan. In 2020, the bank paid $920 million to settle charges brought by the Department of Justice for manipulating precious metals markets through spoofing and false orders between 2008 and 2016. Nearly a decade of manipulation, the largest penalty of its kind in history. At the same time, while their traders were suppressing prices on paper, analysts believe J.P. Morgan was quietly accumulating enormous quantities of physical silver. Estimates range from 600 million to over 1 billion ounces accumulated over the years. Suppress the price, buy the metal cheap, pay a fine later, and walk away with a strategic stockpile. If that assessment is even partially accurate, it may be one of the most profitable trades ever executed. Now fast forward to late 2025. Silver is surging. Paper shorts are imploding. And banks that once leaned on suppression are reversing course. The game has changed. On December 25th, 2025, Chinese silver markets sent an unmistakable signal. Prices in Shanghai surged to record levels, creating persistent premiums over both London and COMEX benchmarks. In some instances, the market slipped into backwardation, where immediate delivery commands a higher price than future delivery. This is extremely rare. Backwardation means one thing and one thing only: physical scarcity. Normally, futures prices are higher than spot prices because storage and financing cost money. When that relationship flips, it means buyers are desperate to secure metal now. They are willing to pay extra just to get it immediately. This is the market screaming that supply is gone. China controls more than half of global industrial silver demand and roughly 70% of global refining capacity. And instead of exporting silver, it is absorbing it. pulling metal from London, pulling metal from COMEX, stockpiling for domestic use, creating a two-tier market, one price for real metal in Asia, another for paper claims in the West. This has profound geopolitical implications. Silver is not just an investment asset. It is a strategic material. Modern weapons systems require it. Missile guidance, radar arrays, electronic warfare systems all depend on silver. Renewable energy infrastructure depends on it. Advanced computing depends on it. Now imagine a scenario where Western defense contractors stand for delivery on futures contracts and are offered cash instead of metal. Meanwhile, the physical supply is sitting in vaults overseas, unavailable. That is not just a market issue. That is a national security vulnerability. And this is where the warning signal from 2008 starts flashing again, brighter than ever. Back then, the world learned what happens when opaque derivatives, concentrated risk, and leverage collide with reality. The collapse did not begin with headlines. It began with small cracks in obscure markets that most people ignored. Today, silver is one of those cracks. The Bank for International Settlements has repeatedly warned about concentration risk in derivatives markets. A handful of institutions hold enormous positions. When losses pile up, they do not stay contained. They spill outward. Margin calls force liquidations. Credit lines tighten. Counterparties lose trust. Liquidity evaporates. United States commercial banks collectively hold trillions of dollars in notional derivatives exposure. Precious metals are only a fraction of that, but losses do not exist in isolation. A bank losing tens of billions in one area must find liquidity somewhere else. That means selling assets, pulling credit, or leaning on emergency support. This is how localized stress becomes systemic. And now, look at the math no one wants to talk about. There are roughly 150,000 open silver futures contracts on COMEX. Each contract represents 5,000 ounces. That equals 750 million ounces of paper claims. Against that, there are roughly 150 million ounces of registered silver available for delivery. That is a ratio of 5 paper ounces for every 1 physical ounce. If just 10% of contract holders demand delivery, 75 million ounces must be delivered. Half the vault is gone. If 20% stand for delivery, the vault is empty. The system breaks. And the pace of withdrawals suggests that this is no longer theoretical. In the first 4 trading days of December, over 60% of registered inventory was claimed. At that velocity, the vault would be drained in under 2 weeks. This is not a slow burn, it is an acceleration. The price levels ahead are not predictions. They are pressure points. Around $82 to $85 per ounce lies a zone where multiple models show stress becoming unmanageable. At those levels, cumulative bank losses would exceed $35 billion. Margin requirements would spike. Credit ratings would come under review. Forced liquidations would begin. That range also aligns with the inflation-adjusted equivalent of silver's 1980 peak. Adjusted for purchasing power, $50 in 1980 equals roughly $170 to $180 today. The market has not even approached that level yet, but unlike 1980, this is not driven by speculative hoarding. It is driven by real-world consumption. Solar deployment targets, electric vehicles, data centers, defense manufacturing all require silver whether the price is high or low. Demand does not disappear when prices rise. It intensifies. And this is where the story starts to turn from market analysis into something much larger. Because when a critical industrial input becomes scarce, the consequences ripple far beyond price charts, far beyond investors, and straight into the foundations of modern civilization itself. Because silver is not optional. It is embedded in the circuitry of modern life. When supply tightens, production slows. When production slows, growth stalls. And when growth stalls while debt remains, systems fracture. This is why the signal matters. Not because silver is rising, but because what it represents is breaking. A world built on leverage, paper promises, and just-in-time delivery cannot survive sustained physical shortages. The warning from 2008 was about credit. The warning in 2026 is about reality itself pushing back. Back then, the collapse started quietly in subprime mortgages before spreading outward. Today, it is starting in a metal most people ignore. But the pattern is familiar. Concentrated risk, hidden leverage, overconfidence, and the belief that the system can always be patched at the last second. It cannot always be patched. When physical supply and paper promises finally diverge beyond repair, prices do not adjust gradually. They reprice violently. Trust evaporates, and once trust is gone, it does not return on command. The signal flashing now is not just about silver. It is about fragility. About how thin the margin has become. About how a single constraint in a critical material can expose the fault lines beneath an entire financial structure. 2008 began with a few cracks no one wanted to see. 2026 is beginning the same way. Quietly, technically, invisibly to most. But for those paying attention, the message is already clear. The signal is flashing again.